This is Mercer Buller, Director of the Business Law Institute at the University of Mississippi School of Law. And this is Luca Pacioli, a 15th century Franciscan friar from Tuscany who is considered to be the father of accounting. Pacioli was the first to publish a description of double-entry bookkeeping. Double-entry bookkeeping is one of the two foundational principles of accounting. The other foundational principle is the fundamental equation, assets equal the sum of liabilities and shareholders' equity. These two foundational principles are the subject of this presentation on the balance sheet. We will approach the balance sheet from the perspective of a lawyer because it is the legal aspects of the balance sheet that are of interest here. And the structure of the balance sheet actually provides a nice vehicle for achieving a deeper understanding of business law. We begin with the concept of a legal claim. Shareholders have legal claims, and one way to think about shareholders' legal claims as to corporations and the assets they hold is to begin with shareholders' equity. Consider a business person who wants to make widgets. He invests $1 million in a corporation and receives 1 million shares of Widgets Inc. in return. We now have the beginnings of a balance sheet. The shareholder's claim on the corporation, his shareholders' equity, will appear as a $1 million claim on the balance sheet in the form of common stock. But where does that $1 million go? He has a claim, but there are no assets behind it on our balance sheet. The cash he puts into the corporation is the asset. This cash is likely to be placed in the corporation's bank account, a type of asset that we will call cash. Note that the amount of the investment on the right equals the amount of the assets on the left. The shareholders' equity entry on the right is matched by an equal entry on the left under assets. This is our first encounter with double-entry bookkeeping. We now have a balance sheet for Widgets Inc. Let's work with that balance sheet. What happens if $200,000 is stolen from the cash account? The cash account is reduced by $200,000. Double-entry bookkeeping requires that we make a corresponding change to reflect the change in assets. The $200,000 reduction in the corporation's assets reduces the value of the shareholder's claim by $200,000. That claim is now worth only $800,000 because it represents a claim on assets worth only $800,000. This is double-entry bookkeeping at work again. Let's restore our original balance sheet and try another transaction. What would happen if the bank account earned $100 in interest? The cash account would be increased by $100. The assets have increased by $100, so the value of the shareholders' claims have increased as well. The right side no longer adds up to the value of the shareholders' claims. So where would the $100 in earnings go on the right side of the balance sheet? The common stock entry represents investments by outsiders in the business. The $100 in earnings doesn't really represent an investment in the business. We put it in a separate category under shareholders' equity called retained earnings. When the value of the assets increases, that increase is reflected in the retained earnings account. Total shareholders' equity is increased from $1 million to $1 million and 100. This is double-entry bookkeeping at work again. Let's restore our simplified balance sheet and build it out a bit more. Widgets Inc. needs more capital to operate its business, but the original investor does not want to put any more of his own money at risk. So Widgets Inc. borrows $1 million from a bank. How is that loan reflected on the balance sheet? The loan, like shareholders' equity, reflects a claim against Widgets Inc. We create a new category for this type of fixed claim called liabilities. The $1 million received from the bank will be placed in the company's bank account and become an asset. The assets are increased by $1 million, and there is a corresponding increase on the right side of the balance sheet. This increase illustrates both double-entry bookkeeping and the second foundational principle of accounting, the equation assets equal liabilities plus shareholders' equity. One way to think about this concept is to remember that the total value of the claims on a company's assets will equal the value of those assets. The value of all claims cannot be more than the company's assets are worth. Now it's time to see how the balance sheet works after the business has been operating. Widgets Inc. uses $1 million of its cash to purchase what we will call property, fixtures, and equipment. Those assets are used to make widgets. It then spends $500,000 on materials that are turned into finished widgets, which we will call inventory. Note that the total value of the assets stays the same. We have only shifted entries within the assets. There is no effect on their total value. Let's see if Widgets Inc. is going to be profitable. It sells all of its $500,000 in inventory for $700,000, a profit of $200,000. The inventory account is reduced to zero, and the cash account is increased by $700,000 to $1.2 million. The value of the company's total assets has increased to $2.2 million. We've made the necessary changes to the asset side of the balance sheet, but our balance sheet does not comply with the fundamental equation. Assets equal liabilities plus shareholders' equity. Assets equal $2.2 million, but liabilities and shareholders' equity equal only $2 million. To comply with the fundamental equation, we need to make an adjustment to liabilities and shareholders' equity. Where should the $200,000 in profits go? It will not go to the bank, because the bank's claim is fixed at $1 million. The profits belong to the shareholders and will be added to the retained earnings account. $200,000 is added to retained earnings, which brings total liabilities and shareholders' equity back into line with total assets at $2.2 million. Let's consider another transaction. The company decides to reduce its outstanding indebtedness. It pays off half of the $1 million loan. What changes will we make to the balance sheet? The cash account is reduced by $500,000, and the loan account is reduced by an equal amount. Both the total assets and the total liabilities and shareholders' equity are reduced by $500,000. Widgets is encouraged by its initial success. It spends $500,000 in cash to purchase more materials, which it turns into inventory worth $500,000. We make the corresponding entries to the cash and inventory accounts. Widgets do not sell as well this time around. The $500,000 in inventory is sold for $400,000. The inventory account goes to zero, and $400,000 is deposited into Widget's bank account. It spent $500,000 to make widgets that it sold for only $400,000, causing a $100,000 loss. The $100,000 reduction in cash is matched by a corresponding reduction in retained earnings from $200,000 to $100,000. Total assets and total liabilities and shareholders' equity now equal $1.6 million. For our last transaction, we will make a distribution to shareholders. Widgets decides to pay a $100,000 dividend. $100,000 is deducted from its cash account and paid to shareholders. A corresponding reduction is made in the retained earnings account. Total assets and total liabilities and shareholders' equity are reduced to $1.5 million. This concludes our introduction to the balance sheet. You should be able to create and make adjustments to a balance sheet for the kinds of transactions covered in this presentation. We made an initial investment in Widgets Inc. and took a loss when $200,000 was stolen from Widgets' bank account. Widgets took out a loan, reduced its indebtedness, paid a dividend, purchased material to create an inventory of widgets, and sold the widgets, once at a profit and once at a loss. For these transactions, we applied the two foundational principles of accounting: double-entry bookkeeping and the fundamental equation, assets equal the sum of liabilities and shareholders' equity, just as Luca Pacioli would have applied them 500 years ago.